Is whole life insurance a scam? Well, they sell you three things, but you only ever really get one, and that's if you're lucky. They tell you it's protection, retirement, and savings all in one policy, but it's not. Today, I'm walking you through what happens to that money at 25, 45, 65, and 100. And the answer might just make you angry. That's not a typo. 3 promises, actually only one payout. And I'm going to show you exactly when that money disappears. So since the whole life insurance agents have joined the comments, I think that it's definitely clear this is still being sold, and this is something that you need to be informed about. So if a whole life insurance agent says to you they want to sell you a whole life insurance policy, ask them one question. Let me see your policy. Is it whole life? If you have one of these policies right now, it is not theory. This is your money. And there's a real chance that it is not going to do what you were told it would do when it matters the most to you and your family. Stick around, because by the end of this, I'm going to show you what that same money would have been worth instead. And that number is going to sting. Here's what I'm going to show you. The 2 types of life insurance and what you're actually paying for. Then 4 real numbers in one policy's life at age 25, 45, 65, and 100. And so this is so you can see exactly where the money goes and where it doesn't. And then I'll show you the alternative. And you can decide for yourself which one your family would choose. Here's a number I want you to hold on to while we go. $75,000. That's the policy in this story. Watch how much of it the family actually sees. There are really only 2 types of life insurance. There's term insurance, and then there's cash value. Now, cash value, you may not be familiar with that term, and that's because it goes by so many other different names. It goes by paid up life, adjustable life, whole life, education savings life, universal life, my life, your life, everybody's life. It's so many different names. It's so confusing at times, and most people don't even know what it is that they have. But this is what is being sold. So term insurance and cash value, which has all of the other names. If it's a name you're confused about, you haven't heard about, 9 times out of 10 is cash value. Different names, same structure. In these cash value policies, they sell you 3 things: life insurance protection, a savings program, and retirement. But you can't actually use all 3 of these separately or at the same time. You're paying for 3, but you're only ever going to get 1. And like I said at the beginning, that's if you're lucky. Term is simple. It's a period of time, whether it's 10 years term, a 20-year term, 30-year term. It's just pure insurance for a period of time. If you pass during that term, your family gets paid. It's less expensive because your family is only paying for one thing, for the term insurance. So let's go through what would happen if a 25-year-old buys a $75,000 cash value whole life insurance policy. Now, a 25-year-old potentially would pay about $50 a month for this type of policy. And what they will sell you on is $23 is going towards the insurance and $27 is going to the savings. So they're pretty much telling you half and half. Half will go to your savings and half will go to the insurance. Say in this particular case, if the 25-year-old makes it to age 26 and passes away, would the insurance company pay it out? It depends on the contestability period and clauses for the insurance company. But if he doesn't commit suicide, if there's no foul play, more than likely the policy would pay out. Many cash value insurance companies try to find a loophole during the contestability period to avoid paying out. So that's something to watch out for as well. Let's just say nothing happens. Tom continues to go about his life and he's flourishing. He meets someone, falls in love, they get married. Now, at the age of about 45, this policy will have accumulated potentially, let's say $13,000, for example, of savings into this program. So he has a $75,000 life insurance policy and the $13,000 in savings. That's how the program has been sold to him. Now, at 45 years old, he may have had a teenager, a young adult, getting ready to go off to college. A lot of parents may buy their kids a car. So let me take out $10,000 in this example. He wants to buy his child a car for school. Now let's just say they drive up to school. They take out the $10,000. They drive up to the school, get the child settled in for college, and unfortunately, Tom does not make it back home. How much out of the $75,000 policy that Tom has do you think that the insurance company would pay out? Now, the family is expecting $75,000, but based on this type of policy and policies like this one, when you remove the cash value, that amount is deducted from the policy face value as well as the interest that has accrued since the loan was withdrawn. So the family would not get $75,000. They may not even get $65,000 because of the amount of interest that may have accumulated to that point. How do you feel about that? That's how policies like this and other ones similar to it, this is how they work. If you borrow and take a loan against the cash value savings that has accumulated, that amount will be deducted from your policy face value along with any interest that has accrued. So your family would be deducted that amount in their final payout. Something to consider. Now let's just say nothing happens at 45, right? And as he's continued to work, continue to, be a responsible citizen, makes it to age 65. Based on the hypothetical savings, the theoretical cash value savings that they would sell, this particular policy may have accumulated about $40,000 in cash value. Now, at 65, a lot of people are retiring, right? They are going on trips, long extended vacations, house remodeling, maybe buying a Winnebago to travel around the world. They're making large purchases, maybe even renovating their home. So let's just say at the age of 65, if Tom had decided to pull out the entire cash value savings, the entire $40,000 or $42,000 that have accumulated at this point, and goes on a road trip, buys a Winnebago, RV, going on a trip, traveling around the world, visiting his grandkids at this point, his children's family, and does not make it back home, unfortunately. How much do you think the insurance company would pay out to the family? Possibly nothing. Well, why is that? Policies like this one state anytime you withdraw the full cash value, the policy is subject to lapse within 30 to 31 days. So if something were to happen to this particular individual at 65, their family would not get paid anything. And you may say, well, I thought that they had the cash. This was their savings. And they had the life insurance that was separate. Oh, they sold them 3 things. But as I stated previously, you only get one. So you will not be able to get this savings because this now is a loan, an interest loan. You won't get the life insurance because the life insurance now does not exist because the policy is lapsed because the entire cash value has been removed from the policy. How do you feel about that? Something to consider. Now let's talk about what happens if nothing happens at 65 and you make it to a whopping 100 years old. Congratulations. Woo, you made it to 100. Great. So now that you have not passed away, Mr. Tom didn't pass away during that term period, which is the whole life period, he would get a $75,000 check. That's what will come back to him. But guess what? There is $75,000 sitting in that savings plan, plus interest that has accrued over this time. Because you must know that the insurance company is not just putting that in a account, not bearing any interest. Oh, it's accumulated interest, of course. But guess what? He doesn't get that. The insurance company gets that savings. That's right. As I told you before, they sell you 3 things: the insurance protection, savings, and retirement. But you only ever get one if you're lucky. How do you feel about that? Now, the alternative would be the same $75,000 life insurance policy for a 25-year-old would be about $23, $25 a month, give or take. With that savings of $27 a month, they could put that into a very conservative interest-bearing account, money market, mutual fund, a very conservative mutual fund type of account, bearing about 10 to 12% interest. If that same $27 going into a mutual fund interest-bearing account of about 10 to 12% from the age of 25 to 65 would possibly grow to about $156,000, $165,000, depending on how the market's doing, could definitely be much more. At the age of 65, with $150,000 in the bank, would you say that that would be enough for the family to bury their loved one? Absolutely. More than enough. Would you say if $150,000 was sitting into your savings account that you could go and buy a car from without penalties, that you could go and pull out $10,000 to buy your grandchild a vehicle, would you say that that would be better than having to pay it back interest with a loan, or having to pay it back out of your life insurance savings that's supposed to go to your family? Absolutely. At the age of 65, if you have $150,000 sitting in a savings account that is yours, that you own, you are self-insured. You don't need a life insurance policy after that age. At 65 and you have $150,000 in a savings account, you're self-insured. You have no loan to repay. This will not lapse. Your savings account will not lapse. You have no risk. This account is yours. It's not theirs. So here are your options. Option 1, you pay for 3 things, only ever get 1 if you're lucky. You have to pay it back with interest, like a bank loan. Or option 2, you can get affordable term life insurance, less expensive, pure insurance, and invest the savings of what you would have had if you would have had a whole life insurance. Which one of these would you think would be the better option for you? Buying cash value or buying term and investing the difference? Which of these would your family choose? Would they want to buy cash value, or would they buy the term insurance and then invest the difference? So, is whole life a scam? Or is it just never explained to you the way that I just explained it? You decide. Get educated on what's actually being sold to you. Be informed. The best time to get term insurance is when you are insurable. And every dollar that you're able to save is yours to invest for your future, to grow and to keep. Comment protect, and I'll send you a link to book a call. We can determine the right coverage for you and get a clear picture of what you actually need and what it really costs. Remember, women retire wealthy. The question is, will you?